Hello and welcome to this webinar. My name is Ben Frazier. I'm the Chief Investment Officer of Aspen Funds. I'm very excited to share with you our latest investment offering in oil and gas called the 116 Upstream Energy Fund 6. This will be a fund that will be investing in multiple direct asset purchases in oil and gas properties and what we believe to be some of the best risk-adjusted opportunities in this current environment right now. This is something we've been working on for about 9 months, putting this fund together. We feel like right now is a really good time to be launching this. We actually have our first acquisition kind of targeted. We'll talk about at the end of this presentation for this fund, and very excited to share with you why we think this is a great opportunity for investors to participate in some really strong fundamentals and things going on in the oil and gas space as a whole. And then why we think these particular types of deals we're going after are the best places to invest in this asset class. So with that, let's dive right in. Before we get too far in the presentation, obviously have to give the disclaimers. This is not a offer to sell or solicitation. You need to review the full private placement memorandum of the fund to understand all the key risk factors and details of the offering. We will be making forward-looking statements and pro forma projections. Again, these are not guaranteed. They're based on a myriad of assumptions, and past performance is not necessarily indicative of future performance. So please consult the PPM. Please consult your advisors to make sure you understand the full extent of the risks involved in investing in opportunities like this. And before we kind of get into the fund itself, I think it would be helpful to give you a background on our team, who the faces are behind Aspen Funds, and for those that maybe aren't as familiar with us, give you a little bit of an intro to our team. So first and foremost, we have our two co-founders here, Bob Frazier and James Mafuccio. They really kind of started this fund or Aspen Funds 10 years ago. And their first fund they did was identifying a very unique opportunity coming out of the great financial crisis in distressed residential mortgages. And what's so interesting about kind of how Aspen Funds started and how we've kind of taken this kind of core competency and focus into the offerings we do today is it really starts with kind of the macro first picture. Our tagline is actually macro driven alternative investments. And what that really means is we're looking and studying the big picture economic tides that we believe will be in play for a period of time. And then we want to invest in those tides, right? Because a rising tide lifts all boats. And so when they started Aspen Funds, it was really opportunistically into this kind of niche asset class coming out of the Great Recession of 0809. And, the first fund they launched was Friends and Family Fund. Didn't really have any expectation beyond that, but it did very, very well. It continued to kind of grow and scale that business to become one of the bigger middle market players in that industry. And then several years ago, kind of taking that same approach of identifying unique opportunities and building out investment offerings around them, we started branching out into multiple other asset classes. And really part of it was driven by our own desire and need to diversify our own capital into these other asset classes, but also our investors, seeing what other opportunities are there out there for me to invest in and to be able to participate in some of these, very strong fundamental trends that are going on. So that's really how we started, doing multiple different types of offerings. The kind of other two members of our management team and our ownership group is Dan Schulte. He's our chief operating officer. He was formerly the general counsel, Waddell & Reed, which was a large publicly traded mutual fund company, was there for 14 years. Before that, he was a attorney and a CPA and actually worked in private practice law for securities law firm. And then after leaving kind of the general counsel role, he kind of transitioned fully into private equity investing. We met him many years ago. He joined our team about 5 years ago to help us really build out our offering set, our deal flow, really institutionalize a lot of our processes, operations, et cetera. And then you have me, Managing Director, Chief Investment Officer. I'm really responsible right now for capital markets, for all the deal flow, for asset management, kind of putting together the kind of big picture deals and structuring them and then helping raise capital. My background was actually as a commercial banker and an underwriter. I worked in banking for many years, evaluating, hundreds of millions of dollars worth of investment loans made to our clients. Then transitioned into kind of the private equity investor side of things about 5 or 6 years ago with Aspen Funds. and have really helped us scale our offerings and what we're doing today. And you may have seen me or heard me on the Invest Like a Billionaire podcast, which we love doing. And then here's our co-sponsor, our joint venture partner in this fund. And I'll talk about this more in a minute, but the way that we put together a lot of funds and offerings is really creating partnerships that we believe complement each other, and where we have really good perspective on the big picture trends going on, how to build and structure very good investor friendly structures and funds. We also want to rely on our partners to have the expertise and the very deep bench and the resources needed to execute on these particular types of assets we're going after. And so we've created a partnership. This has been 9 months in the making with Mahadra Energy Group. They have kind of only ever raised money for family offices. They raised about $500 million into the investment project that they have managed themselves. And so we kind of came together and said, hey, what if we create a fund that appeals to both of our client bases, our investors, and kind of join up forces. And that's where we're here today. We're very excited about the structure. And also their track record is pretty incredible. They've been in this space for over 40 years. They've advised on over $3 billion worth of property value and drilling, and have managed over 5 funds and projects. This will be the 6th fund, hence the name. And so really they kind of started as geological consulting. So Jeff's actually a trained geologist, and they have engineers on their staff. They have a lot of other geologists. They have landmen. So they kind of have the full gamut of resources needed to operate in this space and to really identify the kind of best in class opportunities. Bob Bader, he's the executive vice president of Mahadra. He's been involved really from the outset in all aspects of the business, and really key in a lot of the evaluations of the opportunities in the drilling programs. I mentioned before our process for identifying deals, but really, again, it's looking at those big picture trends. Where do we think the economic tides are kind of showing the kind of next steps forward of where the opportunities are going to be? And then we want to position ourselves as investors through the asset classes and the strategies that we choose to benefit from those trends, so that we can benefit from the rising tide lifting all boats. And then we want to assemble the best in class teams, investor friendly structures, and put together funds like this for investors to participate in these opportunities. One key thing we always like to bring up, but our team co-invests in every single deal right alongside our limited partners, and just investing in the same terms as you, so that we have our own skin in the game. It creates kind of the ultimate alignment of interests, and we have our own capital at play in these funds. And so we're going to be backing up the truck for this particular fund. We're very excited about this. And then our ongoing role is really asset management, acquisition, review, business plan execution, reporting to investors, and continue to help build and structure this fund over time. A track record, we have a 10-year track record operating in multiple asset classes. We manage about $150 million of investor capital, over $300 million of assets. One of my favorite numbers is a $50 million of investor distributions returned since inception. We're a 3-year Inc. 5000 company, which means we've been on the Inc. 5000 list of fastest growing companies for 3 years running on the Forbes Finance Council, also Verivest verified. Our experience across asset classes, like I said, we really don't focus on just one asset class. We like to have exposure to multiple asset classes, finding the unique opportunities in all of them, and then partnering with kind of best in class operators and sponsors where it makes sense. So we operate in our legacy fund is mortgage notes. We have over 3,500 assets in all 50 states across 4 active funds. We have a lot of multifamily and storage assets, class A, B, and C assets, over 3,000 units, industrial and retail. We love these asset classes, about 400,000 square feet we manage. And then the non-real estate, which includes this fund. And this is one of the biggest focuses and largest allocations for our team, and our focus as Aspen Funds this year is oil and gas. We believe this is a very, very compelling opportunity and timing to get into this space. And lastly, have to give the shout out for the podcast. If you're not currently tuning in, definitely encourage you to listen to these episodes. This is called Invest Like a Billionaire. We actually just cracked into the top 1.5% globally of all podcasts. And something that we really enjoy doing. It's really our way to help educate investors around investing in alternative assets, really studying how the ultra wealthy invest, and trying to implement those strategies and resources and things they do into our own personal investment strategies. With that, let's dive right into the executive summary. Very excited to get into the kind of meat here. So this is going to be a $50 million diversified oil and gas fund. We won't be investing in just one asset in one basin and one well. This will be very diversified. You'll get access to a lot of different kind of wells, commodity types, basins, operators, et cetera. And our goal is to go purchase existing PDP. So proven developed producing assets that are already producing cash flow and have existing geology and kind of a engineering report around the cash flow being generated. And then what we're going to do is we're going to take those assets and we want to evaluate them for future drilling opportunities and then participate selectively in drilling in kind of what we call infill drilling opportunities for the upside value. So that's the proven undeveloped assets. And so that'll be kind of an evaluation that we do in every asset that we're looking to acquire. We're going to be focusing on non-operated working interests and overriding royalty interests. I'll get into what that means here in a little bit, but that will be what we'll be focusing on in this fund. I do got to give a real quick shout out here because this is really, really important. If this is a new asset class for you, you've not invested in oil and gas before, I highly encourage, if not require you to go listen to this masterclass that we just put on a week or two ago. This is something that is going to be very, very helpful for you to understand really the basics of oil and gas investing. So we actually brought Jeff on to this webinar, and it's actually now a podcast series where we spent 90 minutes and just broke down what's the energy landscape look like, right? Why should we even invest in fossil fuels if renewables are the way of the future, right? I answered the fundamental question. What are the different ways to invest in oil and gas, right? All the different types of ways to do that. What are the key due diligence items that you need to do when you're evaluating oil and gas projects? So these are really, really key things you should understand. I'm not going to get into a lot of that in this webinar. I'm going to assume a base level understanding. So if you are kind of new to the space, again, definitely watch this masterclass. It's going to be very helpful for you as we kind of go along. Some of the key reasons to invest in this fund before we kind of dive into the structure, the meat of it. Again, experienced sponsorship team. We've been investing in oil and gas for several years. Our partner in Mahajra Energy have a very, very impressive track record, a long time experience investing through multiple cycles of commodity prices and have seen it all and bring a lot of value to understanding and identifying the best in class opportunities. We're going after middle market opportunities. I think this is a really key distinction. A lot of offerings that I've seen for oil and gas are, what's called more drilling programs, just pure drillco plays. And that's basically going after and just, buying rights to drill on, potentially wildcat or potentially more infill opportunities, less risky. But it's really hit or miss, right? If you hit the wells and you hit oil, it can be really good. If you don't, or if you miss a couple, returns aren't as good. They have sometimes good tax benefits, which is what attracts people, but ultimately it's a different level. It's kind of going mom and pop operations. It's going after small scale drilling opportunities. We're going after middle market, and I'm going to get into reasons why we think that's the best place to play in here in a little bit. But ultimately, there's been a lot of capital that has left the industry over the past several years, and a lot of these kind of middle market opportunities that are very institutional quality are not getting the capital that they need to continue to develop the producing assets. And so we're going to be able to get into proven basins with large operators at really good bases on our acquisitions and provide the upside to continue to grow. So we're going after bigger opportunities. And I'll share one that we have an acquisition target on here as an example in just a minute. Our focus on this is cash flow and total return. So like I said earlier, some investment offerings are really focused on really the tax benefits. We're going to front load all of our drilling costs. So you can take those against your income and get some tax benefits. Well, that's a great thing to do, and we will have a lot of tax benefits being derived from these funds. It should never be the primary motivator to invest in something is the tax benefits, right? It needs to be a good underlying fundamental business plan. Mentioning tax benefits, we are going to be passing this through to our investors. I'll get more to that in a little bit. We'll have the optionality for you to invest actively or as a general partner to get those as active losses, or as a limited partner to get those as against passive income. Favorable fundamentals. I'm going to spend some time here in a minute going through why we think the kind of fundamentals of supply and demand in oil and gas right now are really, really primed for investing. Income investment. Ultimately, there's a strong alignment of interest because we are all investing right alongside of you into this fund to create alignment of interest. Here's the co-sponsor track record. So this is something that we spent a lot of time digging into and understanding with Mahajer of the 5 projects and funds that they've done before, of what they are, what have they been able to do. And so they've had five of these projects, 4 have gone full cycle, and these are realized IRRs and MOIC. MOIC is multiple on invested capital, very similar to an equity multiple metric, if you're more familiar with that. But you can see here, the lowest returning one they did was a 21% IRR. One of the highest ones that they have that's been realized is a 76% IRR. But then also the multiple on invested capital is very, very strong in all these scenarios. And so again, they're bringing a lot of experience to the table and a really, really great track record. As we've been on these acquisition calls and evaluating new opportunities, just the level of detail and the not compromising on quality for the assets to really be able to ride through multiple cycles, right? And one thing I do want to note here as well is in this fund, we're targeting a 10-year time horizon, right? So while that feels potentially a little bit long, the reason we've done that is we want to go into this space opportunistically. We don't want to be driven by a time frame mandate like a lot of private equity funds use, right? Because there's a lot of ups and downs. There's a lot of kind of mini cycles within the broader cycle of oil and gas. And we want to be able to have the kind of opportunity and timing and maximum flexibility built in our funds so we can be able to exit when we want to, but not be forced to exit when it's not a good time. The reason I bring that up is while we're targeting that 10-year time horizon, you can see here in the average kind of time span of these past 5 projects, the average that they've kind of held these assets for is 2.5 years. So while we're kind of targeting a long-term time frame, it's really to create maximum flexibility so that we can maximize investor return and investor value. But the goal will be to sell, sooner than that and kind of capitalize when times are good. And we actually believe that probably isn't too far down the road. Or right now, it's a really good time to be buying. There's going to be a really good time to be selling, and that's when we're going to want to be selling. So just want to bring that up. Again, they've invested in assets all across the U.S. in multiple basins. We're going to be focusing in this fund 100% in the lower 48 states. We're not doing any offshore drilling. And a lot of the focus has been in kind of the central portion of the country. Fund overview. Our minimum investment is $100,000. Our waterfall will be very, very straightforward. It's a simple 70-30 split. The limited partners get 70%. The general partners get 30%. Like I mentioned, our hold period is a 10-year hold period. But again, not necessarily saying that's what we expect it to be. It could be a lot sooner than that, but we want to have the maximum flexibility. We're targeting a net annual return of 25 to 30%. IRR will be similar to that because a lot of this will be derived as cash flow, not just kind of the exit value at the end of the day, although that will be a big driver of the IRR. Our target equity multiple, depending on how long we hold it for, if we hold it for the full 10 years, would be kind of somewhere at a 4 to 7x equity multiple or the MOIC number. Distribution frequency is going to be quarterly. Active tax losses, we are going to be allowing you to invest as a investor general partner, if you so choose, to get some of these losses allocated actively. And we are expecting to bring on a little bit of leverage. We think it's going to be actually very, very beneficial for this fund structure, as we're going to be buying multiple assets within the fund to have a line of credit that we can kind of draw up and pay down to make acquisitions is going to make the fund very, very efficient and effective as we're making these acquisitions. We expect the long-term leverage and really even at acquisition not to really exceed that 30% number. So kind of 25 to 30%. It also creates a little bit of kind of amplification of the investor return because the cost of capital on the debt is much lower than the equity expected return. One of the ways we're going to be mitigating some of the risks of leverage is going to be using commodity price hedging. Will be roughly pro rata to leverage to cover debt service costs. So what that means is we're going to be hedging a portion of the production of that we're producing against, kind of future prices. And so that if prices do drop precipitously, we have those kind of hedging contracts locked in place to at least cover the debt service so that there's no real foreclosure risk from a bank standpoint. So again, about the fund, what are going to be some of the kind of key structure items here? We're going to be raising capital for a year and deploying simultaneously as we're raising the capital. We actually have our first acquisition target about to be under contract here, and we'll kind of be the first asset in this fund if all things go well. Due diligence, we may extend that 1 year period to be a little bit longer if it maximizes the value of the fund, the shareholders. We will be accepting subscriptions on a first come, first served basis. So we're raising $50 million. We're going to be kind of taking it in tranches as acquisitions are made. So capital will be accepted first come, first serve. We may go to a waitlist structure at a certain point. If we have more demand, then we have a capital ability to deploy. And in the first year, this is a key thing I want to make a point of. In the first year, we expect to reinvest 100% of the profits into new drilling programs to compound the returns. So we're able to buy this existing cash flow, this PDP, proven developed producing assets. And we're going to take that cash flow we're generating and we're going to reinvest that back into new drilling. So, rough numbers, you can buy existing production anywhere from a 12 to 20% cash on cash return with the kind of expected depletion time curves and, current prices and price projections. That's kind of the expected range of returns for existing production. But you can take those returns and you can reinvest those into new drilling where the expected IRRs are much higher. Obviously taking a little bit more risk, but you're mitigating that with the existing cash flow. You can get anywhere from 30, 40, 50% IRRs through the new drilling. So you can kind of compound and take that cash flow, compound it back into higher IRRs. And so it's going to create more capacity in the fund to produce even more cash flow, as well as increase the overall value of the fund, as a lot of this is derived from production being made. We're going to target distributions to start in year 2 and thereafter growing over the life of the fund. Like I mentioned before, we have kind of 2 ways to invest in this fund. One is going to be as a limited partner, and you can take the tax benefits to offset passive income. You can also invest as a general partner. You take those tax benefits to the degree that they exceed the income coming out of this fund against active income to offset some of those tax liabilities. Again, this is something that you need to discuss with a CPA. Make sure you understand the implications of that. As a general partner, you're getting kind of better tax benefits you can use against active income potentially, but you are taking more risk as a general partner. And so you want to understand what those are. If you have questions, please reach out to our investor relations team. They can describe what those risks look like. What's the opportunity? What's the strategy? So I've already kind of alluded to it a lot here, but there's been a lot of capital that have left the space for reinvesting. And we believe right now is a really opportune time to position for long-term favorable economic fundamentals. So a lot of banks, private equity funds have kind of left the space because of ESG initiatives. A lot of these funds have mandates to invest in ESG initiatives. So it actually disincentivizes investment into fossil fuels. And a lot of the capital allocators got burned a couple of years ago and when oil prices got hit really hard and the market was a little bit frothy at that point. It's not right now. It's a very, very different market. And it's kind of the pendulum has swung to the other side. And so we believe right now you can acquire these really awesome, existing cash flow assets at really good basis and can reinvest cash flow to get the upside. So we think right now is a great opportunity. The strategy, partner with our longtime, co-sponsor operator in the space, long time experience. We're going to use that to identify the best in class opportunities, directly invest in oil and gas plays. We're going to strategically participate in new drilling programs for the upside. We're going to be focusing on non-operating working interests and overriding royalty interests. And the difference between those, so non-operating working interests, you've probably heard of working interests versus royalty interests. The working interests are basically become a direct owner of the working interest and of the operations of the asset. And the non-operated side of this means that we are not the lead operator. We are partnering with big operators that are doing, managing lots of assets and potentially doing lots of drilling programs. And then we can participate alongside of them, get the benefits of their economies of scale, their track record, their expertise, while getting all the benefits of a working interest. And the same thing goes for overriding royalty interests. In that case, instead of owning the mineral or the working interest, you own the mineral rights. And so you're actually leasing to the operators to drill and to pay you a royalty for owning the rights to those leases. So those are kind of the two ways we're going to be investing. We have a lot more detail of that and what those kind of look like in our masterclass if you're not familiar with those terms. Strategy, again, is simple: buy existing production, reinvest that production and new capital into new drilling. Take those cash flows, compound them into higher IRRs. And one of the cool things about this and participating in the new drilling as a non-operating working interest owner, we have the right to participate in these drilling programs, but not the requirement. So what does that mean? That means as a working interest owner, we have the right to participate in any new drilling opportunities that these operators plan on doing. And again, there's kind of multiple different types of drilling. The types we're focusing on what we call infill drilling. This is not wildcatting. This is not exploratory drilling. This is infill drilling, where there's already a lot of existing wells, a lot of existing data to substantiate where the next well should be drilled. And again, these are proven undeveloped wells, reserves, excuse me. And what that means is there's an actual designation of PUD, proven undeveloped, that these operators have to get. And it's a very difficult thing to get because you have to prove the reserves are there within a range of accuracy. And so it's a very high likelihood that the fossil fuels are there. It's just a matter of getting them out of the ground. And generally the success rate is very high when you have those. So our team of geologists will be reviewing every single program. We have, like I said, with our partner here, existing geologists, engineers, landmen that will do all the deep due diligence and all these acquisitions. And we can pick selectively which ones we want to participate on, which ones we don't want to participate on. By doing that, we're going to maximize the value and total return. So it's not going to be a pure tax, write-off play. It's not going to be a pure cash flow play. We will be generating some very strong projected cash flows over time. It's really focused on total return, maximizing the total value of the asset over the time period that we hold it. What are the key risks? What are the mitigants? We talk again a lot about these in the masterclass. I'm not going to dive a ton of time into this, but the key risks here are operator risk, drilling risk, environmental risk, commodity price risk. We feel like we have really good mitigants in place for every single one of these. The operator risk, again, by focusing on the non-operating working interests, we're going to be partnering with experienced middle market and large market operators, some names that you will know, in proven basins, and reducing a lot of the risk of kind of mom and pop operations, the kind of things that lack of economies of scale don't give you. There's going to be drilling risks, right? But I already mentioned we're doing infill drilling, not wildcatting or exploratory drilling. And so these are very high likelihood of success. These are also horizontal wells as opposed to vertical wells. The main focus will be horizontal wells, which again have a very high likelihood of hitting oil. And again, we cover that in the oil and gas masterclass. Environmental risks, there's some of those as a general partner, if you come and sign up as an investor general partner, but also at the fund level environmental risks. But since we're focusing on the lower 48 states, we're not doing any offshore drilling. That's where most of the kind of oil spills happen. We're also going to be reviewing our operators' insurance coverage as a part of our due diligence process. It's kind of a key part of understanding what the insurance programs are in place. And, it's ultimately not a very, very big risk. And then the kind of probably biggest leading one everyone thinks about is the commodity price risk, right? But again, we're going to be employing partial price hedging to mitigate some of that downside risk and to cover debt service costs. But we really believe the probabilities are to the upside pricing. So we don't want to over hedge. So we're actually going to leave as much as we can unhedged so that we can take and capture the upside in pricing. So macro trends, I talked a little bit about, there's some really strong fundamentals going on in this space. I'm not going to dive into all these slides in detail because we cover this actually in the masterclass. But ultimately, the whole kind of ESG movement, the whole kind of green reality and transition to green, it's noble of purpose. Everyone wants to go to renewables. Who doesn't want to do that? But it's very limited in its ability to actually meet the guidelines and the standards set by the IEA, the EIA. There's some key fundamental challenges to hit these projections that we just think are not even in the realm of possibilities. Just given where things are currently at. So while that transition is likely to happen, it may not be for a very long period of time. If you look right now just at the overall usage of global energy, right? We've had renewable sources of energy for a long time, many, many decades. But right now, it actually only makes up 17%, um, or 18.5% of all global energy use in the world. Right now, 83% of all energy use comes from carbon-based fuels, coal, natural gas, and oil. And it's split about a third, a third, a third. So it's just very difficult to replace these sources of fuel because they're very, very cost effective. They're very easy to transport, and we can get them pretty easily out of the ground. And it's been a very, very well established industry. So it's going to be very difficult to displace oil and gas, especially over the next decade or so. One of the key things we want to do is study what the ultra wealthy are doing. And one of the greatest value investors of all time, Oracle of Omaha himself, Warren Buffett, has been betting big on oil. This was a front page article on the Wall Street Journal just a few weeks ago. You can click on the link here to read it. But he's betting big. It's time to find out why, right? And so he sees a lot of value, right? The value right now, what you can get at the prices you can get them at are very, very unique, and what we think is very, very opportune. It's not going to always be this way. So we think right now is a very, very key time to be looking at these types of assets. The last few things to say is supply and demand, right? Because oil and gas are in the ground, they're finite resources. A function of keeping supply at even a stasis place requires new production every year. Every year we deplete about 5 to 7% of global production just through depletion, just through exhausting the reserves in the current wealth. So there has to be a level of reinvestment into new production. But you can see here the chart here. For the past 7 years, investment has dropped by half, by 50%. And so what that's doing is it's going to create a ceiling on the supply, a decreasing ceiling. And it's not something that's very elastic. I mean, we can't just flip a switch and all of a sudden just produce more supply, right? And so there's going to be this kind of ceiling on supply that's going to be challenging to just continue to produce enough energy needs for the globe, especially domestically. And we've been seeing a big, like I said, collapse in private equity funding for a variety of reasons. One of the biggest being ESG initiatives. So we're seeing that kind of leave the space, which is cause a lot of supply to be there. But then you flip to the demand side, right? And so if you're just reading the headlines, you'd assume that fossil fuels are irrelevant in a few years. The reality is that's not the case. Even the IEA, who is pushing a lot of the initiatives for the renewable energies, is still predicting that demand will at least stay the same. And some are predicting that will increase over the next 10 years. And beyond that, the predictions vary of what percentage of energy use is from fossil fuels, but it's still a very big percentage, and it's likely to remain a very large percentage given some of the constraints of transitioning and adopting renewable energies. So, hey, you got decreasing supply, you got steady, if not increasing demand. That generally creates a very strong case to be bullish on oil prices. Now, in the next month or the next few months, it's hard to predict what's going to happen, but we think over the next several years, there's a very strong case for that. And that's being substantiated by some pretty big investment banks. These are just a couple I found that are having, oil price forecasts kind of through the end of this year. And the average is out through 2024, so much higher than we're at right now. And just to be really clear, our base case models that I'm going to show you here in a minute on projected returns are running on a $67 per barrel oil average price over the 10-year time frame. So we're much, much lower. We're not trying to bake in any of that extra gravy through price appreciation into the returns. We want to leave that for the upside and kind of what we believe to be very strong case for it, but not relying upon that to hit our projections. So I mentioned we have an acquisition that we're currently under LOI on. We believe to be under a contract here pretty soon. It's a pretty great acquisition. It's not for sure locked in place yet, but it's a great illustrative example of the types of deals we're going after. If it's not this one, we have like 5 more behind it. So this is something we're want to kind of show you to get a sense of what the assets we're looking at look like. So this particular asset That was sourced through management relationships. It's an off-market deal, just kind of floated to a few kind of key parties. Our co-sponsor has been investing in other projects with this operator for a long period of time. So there's a relational dynamic here. These wells are in the Scoop Stack region of the Anadarko Basin in Oklahoma. We believe they're distressed, undervalued, underdeveloped. The current acquisition, this is what we talked about, buying existing production and then reinvesting for upside through new development, new drilling. It's producing right now already 358 net barrels of oil per day, almost 6,000 of net MCF of gas, and 464 net natural gas liquids per day. So a lot of production coming off this thing right now. Based on the current pricing, expected to generate net cash flow of $727,000 just that month. And one of the cool things about this is we're getting diversification across multiple commodities, right? Not just oil, but oil, natural gas, and natural gas liquids. This is a very a great area in the kind of Midwest for very desirable, one of the most productive areas in the United States. Generally has very strong initial production values, very high quality oil. And then the upside is going to come through already identified 68 potential development drilling locations. And the cool thing is we're not buying that, right? A lot of times when the market's a little more frothy, you're paying for this existing production, but you're actually kind of prepaying for the future development that you're doing. In this case, we're buying these assets, this existing production, really good basis. And so we're not really buying the future value. That is kind of all upside to this fund. The purchase price of the asset is $30.5 million. It's a non-operator working interest alongside multiple operators, large operators. That's 140 wells, right? So like I mentioned before, it's not one well and one basin with one operator. This one acquisition gets us to 140 wells. We're buying this at just under a 20% present value, which basically is similar to a cap rate in real estate. It's almost a 20% cash on cash. And that's baking in all the decline curves of production. That is baking in the current projected price deck over the next several years. One of the valuation metrics that we kind of look at and kind of shows an easy kind of proxy for value and how much you're buying the assets for. We're actually predicted selling these assets at about 35,000. It's called BOE per day, so barrel oil equivalent per day. That's what we think actually is a pretty conservative number. At 35,000, you can trade anywhere up to 45 to 60,000 barrels flowing barrels per day on the back end. But we're actually buying this at around a $15,000 BOE per day. So we're buying this at a very, very incredible value. Again, this is in the Scoop Stack Basin. There's 68 proven undeveloped locations, about 10,000 acres, roughly. And again, we haven't locked this up through a contract yet. Even if we did, there's still due diligence we have to do. So it's not guaranteed we'll purchase this particular asset, but we believe it's a high likelihood. And this is representative of the types of deals that we want to go after. Again, the Scoop Stack in the Anadarko Basin is in Oklahoma. Some of the most sought after oil drilling locations in the U.S. Highly developed oil and gas infrastructure. We covered this in our masterclass, but the infrastructure or takeaway capacity is equally as important as the ability to get the commodities out of the ground, right? But if you can get them out of the ground, but you can't sell them to the end user, to the pipeline companies, it doesn't matter how much you can pull out, right? And that's a big issue in like the Permian, for example, and other basins. They don't have the takeaway capacity that they need to meet all the demand for the supply they're pulling out. Very attractive geology, historically very strong initial production on these wells, competitive drilling costs. They have stacked formations, and so there's a lot of target pay zones at multiple depths. The Stack and the Scoop are actually two different basins within this geology. Here's a cool thing, representative of this particular deal, but we also think this is representative of the larger kind of strategy of the fund. Buying the non-operated working interest alongside big operators, so more middle market opportunities. We get a lot of reduced risk from the operations, working with large operators with proven track records, economies of scale, all resources. And so you can see several of these are publicly traded companies. Marathon Oil, $48 billion market cap. Continental, $27 billion market cap. Devon, $32 billion market cap. Cimarex, 8.5 billion, Ovintiv, 9 billion. So we have 8 operators just in this one acquisition. The diversification, the size of the operators reduces a lot of the risk here. Here's some of the projected investor returns. So again, this is based on a lot of assumptions. I want to qualify that because there's a lot of things that we have to assume here in this kind of base case scenario. So I would encourage you, we have this for download in the investor data room. You can kind of play around with some of the numbers here and understand what's driving it. But the kind of key assumptions here were our average oil price, like I mentioned, is $67 per barrel oil. We think that's a pretty conservative number. It's kind of based on the Bank of Oklahoma price deck, which is generally considered to be pretty conservative over the life of the fund, 10 years. We also are expecting an exit value of $35,000 the barrel of barrel oil equivalent per day. And so you can see here, in kind of the first year, we're not expecting to have any cash flow being generated, but that's being reinvested back into new drilling. They were kind of targeting certain cash flow metrics over a period of time with the big kind of exit when we sell. Again, may not hold for 10 years. In fact, it's probably not the most likely case, but we want to have that kind of flexibility over time. So this is based on a $250,000 investment. Obviously, you can see here the returns are very, very compelling. This is our downside case. So we're now, stressing that model in several key areas. And what it's basically doing is we're holding oil prices down on average for about $57, which is fairly low, especially given some of the current fundamentals that we believe are going to be driving oil prices higher over time. But let's look at the downside here. We're also devaluing the market value of the asset when we sell it by almost 50%, so $20,000 per barrel oil equivalent per day versus $35,000. And then we're also reinvesting about 50% less into new development drilling, which drives a lot of that IRR, right? So you can see here, the downside case is still pretty good. So again, you can play with these numbers in the data room here. And here's just a snapshot of projected cash flow per year with our drilling costs in here, the line of credit and the draws, net income, levered free cash flow. You can play with this again in the model, in the data room. Tax benefits, I'm not going to get into this because this is really a personal discussion with you and your CPA, but there's a lot of oil and gas. We got intangible drilling costs, depletion, depreciation. We're going to maximize everything we can to push these through to the investors. And we're even giving option, like I said, to be a investor general partner to get these actively. But again, have that discussion with your CPA, make sure you understand the risks associated with that. But we believe that at a minimum, a lot of the cash flow for this over time will be tax deferred. Next steps, if you're interested, we definitely encourage you to reach out to our team. In the data room, we have a link for you to submit your commitment. This is not a firm commitment. This is a soft commitment form. So we can understand general interest. We're going to operate on a first come, first served basis. And so if you're interested, definitely sign up on that form. Our IR team will reach out to you and get you the answer to all your questions, get you the next steps. But we do believe, especially this kind of first acquisition, giving some of the compelling kind of value that we believe is already kind of built in to this acquisition. This will go very quickly. So I encourage you to reach out very, very quickly. We will operate on a first come, first served basis to our team to get reserve your spot. With that, thank you so much for going through this whole webinar with me. Hope it was informative. And if you can't tell my excitement through this presentation, we're definitely think there's a lot of opportunity here. No guarantees, of course, but we are investing ourselves into this fund in a substantial way we're very excited about. So again, reach out to our investor relations team, partner with us in this opportunity, and we'll be very grateful to have you alongside. Thanks so much.